Less stress, more time, more money. Welcome to the Cashflow Contractor, short with Martin Holland.
Debt, borrowing money. Hi, welcome to this short episode of the Cashflow Contractor. This is Martin, and today we're going to talk about debt. Now, there's a lot we can say about debt, but the purpose of this short is to give you two tools that you can use to measure your exposure to the risk of debt. Now, William Shakespeare, in his play Hamlet, had one of his characters say to his son, "Neither a borrower nor lender be, for loan doth oft lose both self and friend." Dave Ramsey, more contemporary than Shakespeare, simply says, "Don't borrow money." Debt creates enough risk to offset any possible advantage. Now, those are two heavyweight authorities, and they represent good default positions. If you're not sure about debt, the default position should be don't borrow money. But as with most things, I generally don't agree with absolute statements. And the reason is most of the companies I work with have debt, and they wouldn't be where they are today without it. Sometimes where they are is a good place, as when a new machine or a new facility or new equipment enabled them to enter into new markets or take on some bigger jobs. Or sometimes they're in a good place when debt allows them to survive high accounts receivable or retainages that have been hanging out there for a year or more. It enables us to make payroll while we're waiting for cash to come in. But sometimes where they are is a bad place. And a bad place is when our monthly debt payments overwhelm our cash flow, or when we borrowed money to finance a job that went bad, or when we borrowed money to buy things we didn't really need, such as borrowing money to buy something for the sole purpose of saving on taxes. The thing about debt is that we have to pay it back. When we borrow money, we have to pay it back, and we have to pay it back out of future profits. Someone said recently, I can't remember who, that debt is just an advance against future profits, and that pretty well sums it up. The problem is that debt is certain, future profits aren't. Shakespeare and Ramsey really offer harsh assessments of debt that are grounded in experience and reality. And although debt might work to smooth cash flow or speed growth, it is always a risk. It might work is always a risk, and it should never, ever be taken lightly. This short is about giving you two ways to measure your current exposure to risk that comes from the debt that you already have. These measurements are expressed as ratios, something per something, and they give you objective information. The two simple measures are your debt coverage ratio and your current ratio. And by the way, your bank uses both of these ratios when they're determining the health of your company and deciding whether or not to lend you money. Okay, the debt coverage ratio. I'm going to explain how to calculate it. The simple way is to get your bookkeeper or your accountant to calculate these ratios for you, but I think it's worth understanding how to calculate them. It adds some light to what they mean. So you need your profit and loss statement to calculate the debt coverage ratio. You need your profit and loss statement and need a list of all your monthly recurring installment debts. It's your equipment payments, your truck payments, your mortgage payment, your line of credit payment, operating note payment. But anyway, you need a list, of the monthly payments for all your recurring installment debts. Okay, you add up all your monthly payments to get a total, and then you divide your monthly net profit by the total amount of your payments. For example, if your monthly debt payments are $25,000 and your company makes $50,000 a month, you have a 2-to-1 debt coverage ratio, which really says that you have $2 available through profit to pay each $1 of debt that's due each month. You can add new payments to that and do the calculation or anticipated payments before you actually incur them and see what effect it has on your debt coverage ratio. If you ask banks, if you look on the internet, if you just talk with people who are familiar with finance, they'll tell you that the debt coverage ratio should not drop below 1.25. In other words, you shouldn't have less than $1.25 profit for each dollar of payments that you make every month. I personally think that that is kind of skinny and like to see at least $2 available through profit for every dollar of debt. Okay, the next ratio, that was the first ratio, the debt coverage ratio. Your current ratio, you need to have your balance sheet to calculate this one. And on your balance sheet, look for two items. There will be a line on there that says total current assets. Current assets are things like cash, accounts receivable, and inventory that are likely to be converted into cash quickly, meaning in the next 30 to 90 days. Okay, then look, once you have that number, your total current assets, find your total current liabilities. Current liabilities are those things that will likely require cash pretty soon. Things like accounts payable due to your suppliers or credit card debt. So you can see what we're doing in the ratio is comparing cash that's likely to come in to the total cash that's likely to need to go out in the near term. If you divide your current assets by your current liabilities, you'll get your current ratio. For example, if your current assets are $1 million and your current liabilities are $500,000, your current ratio is 2 to 1. Again, it's telling you that you have $2 of current assets for every dollar of current liabilities, which is pretty healthy. Again, if you talk to banks and you read up on the internet, read financial statements, a lot of times you'll see people say, hey, 1.2 to 1 is pretty good, meaning 1.2 of current assets, $1.20 for every dollar of current liability debt. I think that's kind of skinny, but that's me. But in every case, debt imposes risk, a threat to the future, and we have to respect it. Through these two ratios, we can get an objective measure of how much risk we're already exposed to from debt. And that information will help us with future decisions and might even guide our actions as we decide to improve the ratios. So that's the message. Either do it yourself or have your accountant or bookkeeper come up with them. But you must know every month, it should be a regular report, your debt coverage and your current ratios. They're valuable information. And I promise you, if you know those two things, you will be among a very small few business owners who know that about their companies. And before I go here, back to Shakespeare. He said, neither a borrower nor a lender be. And we've been looking at the borrower side as when we borrow money. But we also lend money. And I think you're on to me here. We don't lend money like banks lend money, but we certainly lend money to our customers in the form of accounts receivable. And that is money that you lend to people. Shakespeare says don't be a borrower and don't be a lender. It may be an absolute, but I'll have to say I'm always about keeping accounts receivable to a minimum. Accounts receivable are always bad, and the only reason that we allow people to have it is to get some sales, and basically because they don't have the cash to fund their businesses. We shouldn't be in the business of lending money to our customers, at least not any more than the absolute minimum. There are ratios to measure how well you're managing the money that you lend out. And we'll go into that, but that's another short topic podcast.
Thanks for listening to The Cashflow Contractor. Check out our website in the show notes or visit thecashflowcontractor.com.